Chip stocks are down massively today and this week, but smart money is buying the crash. Now, retail is missing this, and they're going to miss the run-up when these stocks explode, as I do think the stock prices on Micron and SK are going to run up huge in the coming weeks and months. So let's talk about that in today's video, guys. Smash like, smash subscribe. Lost about 0.4% on the portfolio today, still a little over 1.1 million. How are you guys doing in the stock market today? Let me know. Now, for those of you that don't want to stick around for the whole video, I'm going to give you the straight bullet points as to why, smart money is buying, retail investors are missing it, and because of that, they're going to miss the run-up when these stocks go up huge in the near future. And guys, if you also want to see which stocks I'm buying in the $1 Million portfolio, join the Patreon. You'll see which stocks I'm buying and the method I use to evaluate stocks. Now, I've got 5 key reasons here why smart money is buying the stock despite the fact that they are crashing. I'm referring to chip stocks here, and more specifically, Micron stock and SKHY Hynix. Now, 1, competition, Chinese competition creating memory chips. People are worried about that, but that is not going to be an issue, and I'll tell you why if you want to stick around. Forward PE, smart money is buying SK and Micron. The forward PE is ridiculously low, but people are skeptical that demand can keep up with how it currently is, but we'll talk about exactly why those people are wrong and why this tiny PE has to go up in the near future. AI skepticism or risk off deleverage. This is psychological, folks. People are simply tired of the enthusiasm for AI, right? The build out, the data centers. People are saying they're spending too much money. It's going to crash like the dot-com bubble. This is psychological, and I'm going to show you exactly why. The data is pointing exactly opposite of this. And this is really, a human psychology thing where people are faking themselves out, and smart money knows this. Of course, we have geopolitical conflict with the Iran conflict. We'll talk about that in a second as well. We know Trump has been going back and forth with Iran, oil is expected to keep going up, inflation potentially to come back. We'll talk about that in a sec. And TSMC earnings. The fact that TSMC reported record earnings, but the stock for TSMC went down, really showing that sentiment across the board is showing nervousness for the CapEx spending, because not only are hyperscalers spending massively on CapEx, but now these chip makers are spending on CapEx as well. And TSMC said they're going to spend around 60 to 70 billion in the next couple of years on CapEx, and the stock price went down. Because of that, people think, well, is this CapEx spending going to pay off? But it is going to, and I'm going to show you exactly why. So stick around, guys, if you guys want to see the details of these issues. Now, CXMT, China's top memory producer, CXMT, is tracking towards 350,000 WSPM by year end, coming with 25,000 wafers on Micron's entire, coming within 25,000 wafers of Micron's entire capacity. Now, essentially, guys, people are worried that China is going to make these wafers more cheaply, and this is going to cut into not only Micron and SK's market share, but their margins as well. But we're going to talk about exactly why that's not the case. Really quickly, what is CXMT? Now, Changxing Memory Technologies is China's premier homegrown manufacturer of dynamic random access memory chips, founded in 2016 and headquartered in Anhui. The state-backed national champion has quickly scaled to become the world's 4th largest DRAM maker, trailing only the 3 giants Samsung, SK, and Micron. Now, the company is currently capturing global attention due to its record-breaking multi-billion-dollar stock market debut and its massive capacity expansion amid a global AI-driven memory chip shortage. So in short, guys, China is trying to get into the chip game, right? They're trying to get, their companies to grow, capture market share, capture revenue. And, not only is this an economic thing, but this is a national security thing, right? The big countries like China and the US want to have their own chips, right? And we saw that in the pandemic. When we had to rely on other countries for their chips, that became a big issue, right? And that is why companies like Micron, who are developing these chips in the US, are a massive play, not only from a financial standpoint, but from a national security standpoint, right? So do you think that the US government is going to allow companies to buy Chinese chips? Probably not, right? They don't really allow it now, so they're not really going to allow it later. Second of all, this company, they're really good at making DRAM, but they do not know how to make HBM, high bandwidth memory. And this is what's driving, these sales for chips in the AI build out. They're using HBM chips, which really requires highly, highly complicated IP. It requires, a ton of CapEx spending, and it's hard to really just jump into this and say, we're gonna build our own chips, right? Because if it was that easy, the hyperscalers would do it. Apple, Google, they would be doing it, in 90 days they'd have it going. But it's difficult to do, and that's why, you're not gonna see CXMT start selling, HBM chips at scale in the near future. You're just not. So because of that, because of the IP, because of the complexity of the HBMs, and because of the, the geopolitical issues there where, the US is not gonna want Chinese chips and a lot of countries are not gonna want Chinese chips, we don't really expect this to compete at scale with Micron and SK anytime in the near future, folks, anytime. Secondly, let's talk about the forward PE, guys. The forward PE is ridiculous, and check this out. For those of you that don't know, and most of you do know, but just really quickly for the beginners here, a PE ratio is a price to earnings, right? Now, the price of each individual stock divided by the earnings that each stock brings in, the profits. And the forward PE is taking, the projected following 12 months of earnings and dividing that into the price of each share. Now, the S&P 500, just for reference here, it has an average forward PE of 21 times earnings, right? So if the stock makes, $1 per share, you're paying $21 for each dollar of that profit per share. Now, SK and Micron are both currently trading at around a 6 times earnings, a forward PE of 6. That's less than a third of what the average S&P 500 is trading at. That is ridiculous. That is an insane discount, right? And even so, even with this being the case, the stock prices have continued to plummet, and let's talk about why. Now, investors are concerned that these cyclical earnings are at peak and will drop in the next 12 months or so, and therefore it will not be able to keep up with these earnings, right? So what happens? If earnings don't keep up with where they're at now, those earnings can drop, and essentially this forward PE will go up just organically because earnings are going down, right? Because if you divide this, if you divide by a smaller earning, you get a larger overall forward PE, right? If that kind of makes sense. It's a little hard to explain on a short video, but I think you kind of get the idea there. So people in a nutshell essentially think that demand is going to plummet in the coming 12 months. And because we're going to be in a cyclical earnings market like we've been, right? So memory chips fundamentally have always been cyclical, right? It's almost like gas, right? When the economy is doing well, gas goes up because people are buying more gas. Then when the economy crashes, gas tends to become cheaper because suppliers lower the price in order to, increase the demand for it. Kind of similar thing with chips here in a nutshell. And it's tended to be cyclical. Now, the thing is, people are not taking into account the second and third order thinking. And I'm going to explain this to you. This is one of the things that retail is missing that smart money understands, and that's why they're buying this massive dip. Now, a couple of things. First of all, not only is demand forecasted to last well beyond 2030, which is about 3 to 4 years from now, we have data showing that even if the hyperscalers want to back out from this demand, let's say they want to back out, they want to pause building AI data centers. So let's say, like Google, Amazon, they don't want to build Facebook as many data centers. They're just going to flip a switch, stop buying, and demand's going to plummet, and we're going to maintain this cyclical environment for chip stocks. That literally cannot happen, and we're going to show you exactly why. Check this out. This is what smart money understands, guys, right? Because retail, they take a look at this and they say, well, the prices have been going up massively. Hyperscalers have been spending insane on CapEx, but that has to drop at some point. And if they decide to, just stop, they're going to flip the switch and stop immediately. But essentially, they can't do that, right? They're locked in contractually for multiple years. They're essentially forced to spend this money on these chips for at least the next 2 to 4 years, and we'll take a look and see why. So major US hyperscalers, Amazon, Microsoft, Alphabet, Meta, Oracle, are projected to invest over $700 billion in collective capital expenditures driven by aggressive AI infrastructure development. Approximately 75% of the spending targets AI compute and data centers. Now, AWS is targeting approximately $200 billion to scale AWS, Microsoft Azure about $190 billion, Alphabet about $185 billion, and Meta about $145 billion. Now, a lot of people think, well, they're just going to decide not to spend this, right? They're just not going to do it, or they're going to stop in the next 12 months. Now, check this out. Do they have obligations to continue to spend through the next 1 to 3 years, right? Bringing us into about 2030. Yes, hyperscalers have binding multi-year financial obligations that make a meaningful near-term reduction in AI capex legally and logistically impossible. Now, while their guidance to Wall Street is technically discretionary, so essentially, they tell Wall Street, we're going to spend $200 billion on capex, that is not legally binding, but their underlying infrastructure contracts are legally binding. So hyperscalers are locked into massive spending over the next 1 to 3 years through specific structural obligations, what they call take or pay power purchase agreements. Decade-long commitments. Hyperscalers have signed massive 10 to 20-year PPAs with nuclear, solar, and wind providers to power future AI data centers. So essentially, they've signed 10 to 20-year agreements to buy this energy from nuclear, solar, and wind providers, and they're going to have to buy that regardless, right? So what do you think is going to happen? Do you think they're going to buy the energy and not continue to build the data centers that need the energy? It's possible, but it's not likely. Mandatory payments. They have to make these payments even if they don't use the energy. So what does that tell you? If they're going to spend the money, they're going to want to use those data centers. Number 2, long lead silicon and component pipeline liabilities. They have signed irrevocable purchase obligations. Securing advanced AI accelerators requires placing non-cancelable 12 to 18 months in advance. Non-cancelable orders. Advanced packaging lock-ins. So these hyperscalers have legally committed capital to securing limited capacity for manufacturing the packaging of the chips, and specifically the high bandwidth memory, HBM, at locations that we spoke about earlier, through 2027 and 2028. Breaking these contracts triggers severe financial penalties and forfeits future priority supply. So they have locked in contracts for the next 2 years to buy these chips, and if they don't take them, they still have to pay for them. Then they have data center leases, so a lot of these data centers are actually not building themselves, they're leasing them out, and they've signed multi-year leases, 5 to 15-year leases. So even if a hyperscaler decides to pause AI software scaling, it's still obligated to pay billions in annual rent for physical data centers. And then lastly, guys, we have enterprise customers. These hyperscalers have signed multi-year deals with their customers who want to use these data centers. So if they don't build them and they're not available for the customers, they're going to have a massive breach of contract issue on their hands, not to mention a reputational disaster, as they would not be able to provide these services for their customers. Now, all of this shows that they are legally required to continue building these out for at least the next 3 years. They've signed up for this. This is happening, right? So with all that infrastructure being built out, how can they build it out without the memory chips, right? And the memory is the most expensive part of the process. Then, of course, guys, we have these last 2 factors here. We have the conflict with Iran. Of course, this issue has been ongoing much longer than we thought it would. I mean, we all pretty much know Trump, says things because he wants to get his way and he thinks he can back his way out. Unfortunately, he's kind of backed his way into a corner here, but we don't expect this to last more, we don't expect this to be a 20-year conflict, right? We expect it to resolve eventually, and unfortunately, what people are thinking right now is that inflation could go back up, as it's been ticking up generally, although last month CPI went down for the first time month over month in like 6 years. But generally, it's been going up for the last year, right? It's been ticking back up in a major way. They think that might continue to happen. They think gas might go up, which obviously makes everything go up across the board. That could put the economy in a hard place, essentially leading investors to take a risk-off mentality, rotating out of risky chips and rotating more into, defensive plays That's what's happening here, guys, but that we expect to be a short-term issue, guys. Do we really think this Iran conflict is going to derail the AI renaissance? I don't think so, guys. I really don't. And lastly here is the TSMC earnings. TSMC reported blowout earnings, massive profits, massive, revenue growth across the board, just printing money. But they also said that they expect to spend 60 to 64 billion on CapEx. And this scared investors, right? Because CapEx is a nasty word in the stock market right now, right? It's kind of like when you see hyperscalers spending on CapEx. People are getting scared that they're spending too much on CapEx and they're not going to get an ROI. Same thing here with chip stocks, right? They're seeing CapEx spending and they start selling the stock. And that's kind of like a contagion. People start thinking, well, is SK Hynix spending too much on CapEx? Is Micron spending too much on CapEx? Because we do expect them to spend massively on CapEx. But the thing is, this is going to have massive ROI, guys. Let's take a look at this. Let's take a look at TSMC's recent financials. So they said they're going to spend 60 billion on CapEx. Net income. So net income is bottom line profit, right? Just in the last quarter, they made 22 billion. So they're going to spend about 3/4 of profit building out their infrastructure. That seems reasonable, right? And they have stated, it's on record, experts agree, that this shortage is going to continue for at least the next 3 years. They expect next year's shortage to get even worse. So they would be ridiculous to not invest their money into more CapEx, right? Now, when you're a company and your obligation is to the shareholders, you need to allocate capital properly. Now, they could put this capital in treasuries and get a 4% yield. They could use this capital to buy back their own stock, and maybe, get a multiple on that. Or they could use this capital to build more factories, to create more chips, to sell more chips and make more money. That is where the ROI is, guys. And like we said, they can't just turn off the AI build out by flipping a switch. They are locked in for years contractually. So guys, let me know your thoughts on that in the comments. I did buy SK Hynix shares on IPO. I plan to continue to buy SK and Micron. Let me know your thoughts. And again, if you guys want to join the Patreon, see which stocks I'm buying and see the method I'm using to build and grow my $1 million portfolio, click the link in the description there. Hope you guys are doing well, and I'll see you on the next video.